All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
It's 10 a.m. Pacific time here on Friday the 13th of June here. It seems like a slow week. Let's stay out of the politics and the protests and look forward to a great Father's Day weekend full of sports. We got the U.S. Open, golf going on. We have Club World Cup soccer and Gold Cup soccer going on, both in the U.S. and Stanley Cup Finals. And I would have mentioned the NBA Finals, but I looked. And they play tonight and Monday, so technically not on the weekend. But pretty good sports for those of us that like to follow a wide range of sports.
Yep, excellent lineup.
Yeah, and it was a pretty quiet week. Seemed like it was pretty not much going on there, and kind of the stock market shows it. S&P up 30 basis points for the week. Looks like the big winner is energy, up over 5% on the week. But if you kind of look at it, energy's up 7.5% today. So if obviously you can't just take out that 7.5% because you don't know what the stock market would have done otherwise. But up 7.5% today. So call it down 2.5. It would have been the biggest loser of the week going into if you kind of took out today's moves. But energy, the big winner. Tech number 2, up 1.1%. And oh, I'm sorry. I got it backwards. Tech is the number 3, 1.1%, and healthcare up 1.9% on the week. The second number 2 winner behind energy. Looks like only a few losers out there. Financial is down almost 2%. Industrial is down 1%. Those are your underperformers on a week-to-date basis. Russell 1000 kind of flat. Russell 2000 down 50 basis points or so. Both growth and value also flat. So pretty quiet week across the board. You kind of look at the S&P equal weight index, and that's down 4 basis points on the week. So not much breadth of movement. Kind of everything kind of muddling along. It kind of feels like, as we were talking about, Ryan, right before we hit record here on the podcast, seems like we're in the midst of summer here already, and we haven't even hit the middle of June.
Yeah.
And next week is a kind of a weird holiday week with a Thursday holiday. So I'm sure Friday will be quiet, and Monday, Tuesday, Wednesday might be a little bit busy, but we'll get into that a little bit later here. On the bond market side, you have 10-year down 7 basis points. You have the 2-year down 6 basis points on the week. 2 years now down below 4% at 398. 10-year at 444 as of time of recording here. And the long bond, everyone's kind of keeping an eye on that since it's close to that kind of 5% level. But we're now at 493 on the long bond, and down 4 basis points on the week there. Interestingly, we'll kind of talk about what's going on. As I mentioned, energy up so much today. A lot of that's on the back of oil, and you have WTI crude oil at, let's see, we're at 72.15 as of time of recording, up 10% on the week. Most of that is today. Bloomberg Commodities up 174 on the week. And energy, the big leader there, up 4.5%. Precious metals up 2.5%. And yeah, it's all on the back of gold, up 3% on the week to 34.28. That's where spot gold is right now. And a lot of that, interestingly, is on the back of some conflict in the Middle East. And I thought it was interesting to come in today and look and see that Treasuries are down in price, up in yield on a what you would presume would be a flight to quality day today. But kind of Treasuries acting the opposite. And it's pretty significant. The long bond down almost 1.5 points on the day today. The 10-year down 20 ticks. Kind of an interesting market movement from the long bond.
Yeah,
From
totally.
The bond market, yeah.
And Treasuries kind of found a bid earlier in the week following the soft inflation data that we'll get into, and some of the weaker labor related data. And it kind of just quickly reversed this morning on the geopolitical risks. And I'd also note too, the dollar hit multi-year lows. I think it was yesterday at a 97 handle on the DXY index. And that was also on the back of kind of that weaker inflation data. But has since found a little bit of a bid today. So glimmers of dollar holding on to its safe haven status, at least for the morning goes.
Yeah, and it's interesting just to kind of see how things are playing out here. And With that, I mean, let's get right into macro because it was inflation week. We had CPI and PPI, but that really I really didn't move markets too much there on either of those. It really seemed like the jobless claims data was I guess, the big worrying indicator out there for the week. Sorry, I didn't mean to front run you too much there, Ryan. Um, yeah, but why don't you hop into the macro side?
Yeah, as you mentioned, it was a pretty interesting week on the eco front. Inflation data was front and center, which came out on Wednesday and Thursday with CPI and PPI. But just to start the week off, we had the New York Fed's consumer inflation expectations survey for May. Don't normally bring this data series up, but as we have been seeing, pretty elevated rises in inflation expectations in like the University of Michigan data. Thought it'd be helpful to bring this one up because we are seeing a bit of a decline in consumer inflation expectations. Based on this report, we saw that your median one-year inflation expectations dropped to 3.2% from 3.6% in April. And the 5-year inflation expectations declined to 2.6. And this is much more in line with what we're seeing in like market-based measures like break-even inflation rates. And it speaks further to, a theme we've been talking about over the last few months where the University of Michigan consumer inflation expectation seems to be a little bit disjointed and anomalous, and you're not really seeing it being reflected in other data series. And this morning we actually did get an update on the University of Michigan, which I'll end on. On Monday, we also had the NFIB Small Business Optimism Report for May. We saw an improvement there for small business sentiment. That's in line with improvements we've seen from Conference Board and University of Michigan. So we are seeing a bit of a rebound in in small business expectations, just given the pullback on the trade war conflict. And then on Wednesday, this was the main event of the week as far as the economic data goes. We had the CPI report for May, which came in softer than expected, and I believe it was the fourth month of consecutively of surprising to the downside for CPI. So very encouraging for the Fed. And interestingly enough, like this is when you would expect to see the impacts from tariffs start to feed in through the inflation data, and you didn't really see that. Just getting into the actual numbers. So for the headline CPI, we saw only an increase of 8 basis points month over month. That was below the consensus of 20 basis points. And that brought the year-over-year change to 2.4%. On the core, it also surprised to the downsides. This excludes the volatile food and energy component. That rose 13 basis points, which is below the 30 basis points consensus. And we saw the year-over-year rate stable at 2.8%, which was actually it's the slowest rate since March 21. And if you're looking at kind of more, trend run rates, like the 3-month annualized rate, core CPI decelerated to 1.7% annualized. So definitely heading in the right direction, and the Fed will be very pleased. Digging through the underlying data, as I mentioned, it doesn't appear like the tariffs have really had an impact yet on the data like you'd expect it to feed into core goods. That was actually a negative month-over-month print at -4 basis points. And we saw used cars and trucks down again, 54 basis points. New vehicles surprised. That was down 29 bips. So it's really surprised a lot of strategists out there and economists on, why haven't we seen the tariff impact feed through into CPI prices yet. So um it's gonna be very important over the next couple months to see if we get maybe a delayed response from tariffs. Core services, that ticked up 17 basis points. That was also kind of, at a 2% run rate, encouraging. And then importantly, you have owner's equivalent rent. It's been a sticky component of the CPI and a very large component of the core basket. That decelerated to up 28 basis points month over month. And so we're seeing the year over year OER number drop to 4.16%, which is the slowest rate since Jan 22. And as we've mentioned before on previous calls, if you look at kind of alternative rent data from Zillow and Apartment List and HPA from Schiller, that is indicating further downside disinflationary forces for this OER component. So overall encouraging. On the super core number that the Fed was paying close attention to. Maybe they'll start paying more attention to it now, but since it's moving in the right direction. But that only rose 6 basis points. And while the year-over-year number ticked up to 2.9% year-over-year, the 3-month annualized super core number is actually only running at 10 basis points. So that's very encouraging for the Fed, and this is much more closely related to wage growth. Um, so I'd put this in the win category for the Fed. Then the following day, on Thursday, we had producer prices that also surprised to the downside. And again, I think this was the 4th consecutive month of surprising to the downside. You had the final demand number up 13 basis points. That was below consensus of 20 basis points. The year-over-year number ticked up to 2.6, which was in line with consensus. But you're looking at the core number, core PPI, which excludes food, energy, and trade, which are the volatile components. That only rose 5 basis points, which was well below the 30 basis points expected. And you saw the year-over-year number decelerate to 2.7 from 2.9. And then importantly, economists use CPI and PPI inputs to model PC, which the Fed follows more closely. And based on CPI and PPI reports for May, it's pointing to a pretty benign read for May for PCE. So they're expecting core to rise 14 basis points in May, which would see the year-over-year number rise modestly to 2.6, but the 3-month pace would decline to 1.4% annualized. So again, that's we're moving in the right direction, and so far we haven't seen tariffs really feed through into the inflation data. Bloomberg had an interesting article out yesterday, just following the PPI report, saying that it looks like we're seeing early signs that companies may be absorbing some of the higher costs from tariffs in their margins. They point to PPI of finished consumer goods. That looked like it spiked in May, and that would be on the back of higher tariffs. But that hasn't fed through into the CPI data. So based on their analysis, they think that maybe we're seeing some of the price being absorbed into corporate margins, which that would definitely benefit the CPI and inflation dynamic. But maybe not so beneficial for equities. But all this being said, very encouraging report, very encouraging series of reports on the inflation front, but still early innings on how the tariffs are going to impact inflation. So we're still, a lot of uncertainty. Gonna have to wait and see how the inflation evolves over the summer.
Yeah, I think that, looking at it, you really couldn't realistically, ask for more if you were the Fed in terms of the CPI and PPI. But I think your point about the companies absorbing maybe some of this tariff cost right now is interesting, because just given the volatility in the tariffs and whether they're on or off or they're delayed or they're deferred or whatever the case may be, I think maybe companies are like, okay, we can eat this tariff cost for the 3 months or the 90 days until we get more, surety on whether it's going to be last going forward. And so I think that you could get a case where if the tariffs kick in or they are increased from here, you might see a larger impact to inflation, from that point on. And so I think that kind of puts the Fed in a hard place because they are thinking about, whether the tariffs are going to increase inflation or increase inflation expectations. So that puts them in like, okay, do we really want to cut rates here if, we're going to get another, another round of inflation on the back of these tariffs? And so, it's kind of, you're right. We're in wait and see mode. But if you don't see any inflation effect or tariff effects in inflation, how long are you in wait and see mode before you kind of just give in and say, okay, well, maybe tariffs aren't inflationary?
Yeah, and I think ultimately what's going to move the Fed's hand is the labor market, and if they see any further deterioration there, they will probably begin their cutting cycle, and that's a good segue into the initial jobless claims data that we got on Thursday, which did show a bit of a deterioration in the labor market. We saw the initial jobless claims, that was unchanged at 248,000, a little bit above consensus. The 4-week moving average, which kind of smooths out the week-to-week volatility, that increased to 240K, which was the highest level since August 2023. And then we also saw continuing claims rise 54K to 1.96 million, which was the highest level since November 2021. So, it is looking like perhaps just, based on this rise in continuing claims that the labor market's not falling off a cliff, but it does seem like laid off workers, it is taking them longer to find new jobs. On the initial claims front, I would say that there appears to be some like residual seasonality in the initial claims data. You tend to see these rises in initial claims through like the months of June, and it kind of peaks out over July and then subsides in the third quarter. So again, it's kind of, we got to wait and see if this is some residual seasonality or the beginning of a further weakness in the labor market.
Yeah, I remember like last year going into the summer, as you said, those numbers, jobless claims numbers were creeping up, and the Fed got a little spooked and you know uh, cut 50 in
Rates.
September off of
Yeah.
that, right? So it's like, are they going to be are they going to be fooled again? Well, I guess we'll have to wait and see.
Yep. They're looking at the same data we're looking at, and it's and you're only as good as the data you look at. And sometimes especially given like this post-pandemic world, there is some underlying issues with seasonal adjustments and the like.
It definitely seems like it.
And then this morning we had our favorite, the University of Michigan Consumer Sentiment Survey, that showed a rebound in consumer sentiment, as we kind of would expect, just given the rise in stocks and pullback in the trade war rhetoric. And everyone's been focusing, as we mentioned before, on these inflation, consumer expectation of inflation, and as you would expect as well, we saw pretty significant decreases in 1-year inflation expectations that dropped to 5.1, and the medium term or long run inflation expectations dropped to 4.1. And again, we would take these numbers with a grain of salt. They're still very elevated relative to other measures. Um, so to be discounted to a degree.
Yeah, I'd say more than a degree. I feel like we can put this in the ADP bucket of don't even pay attention to it.
Yeah, I agree. I agree. Maybe
All right.
I'll stop talking about
All
it.
right. If we shift focus slightly to the Fed, we do have a Fed meeting on Wednesday. Right now, I'm looking at the interest rate probabilities, and there's a 0.3% chance of a Fed hike. So we'll call that 0. We have a 20% chance of a Fed cut here in July, and we're up to 79% chance of a cut in September. Still at like 1.9 cuts for the year. It's been bouncing around that kind of two cuts in the year range. We were up above 2 on the back of those jobless claims numbers yesterday. Given the market moves today, we're back down to 1.9. So the market really doesn't know what's going to happen, and really doesn't really have an idea of what the Fed's going to do. And I guess that we're on the same page there. If we kind of look on to next week, as we mentioned, short week, holiday on Thursday. Tuesday, we do get retail sales. So that should be a very important number, kind of see how the consumer's doing. Let's look at the X autos and gas. It's expected to be up 0.4%. It was the 0.2% last month. The control group, which goes into GDP, is expected to be up 0.3 from 0.2 last month. The top line number expected to fall, actually negative 0.7, but a lot of that's on the autos and gas, obviously. We do get import prices, so it's always a one to look at. That's also on Tuesday. Kind of get another look at inflation from that side of things. And then on Wednesday, we get jobless claims on Wednesday because of the Thursday holiday, so we get those a little bit a day early. So keep an eye out for those on Wednesday. Expected to be kind of unchanged from there. And then also on Wednesday, we get the Fed rate decision. So they'll probably have the jobless claims numbers a little bit early, I would expect, before they go into their rate decision. As I mentioned, no rate changes there. And then on Friday with the LEI, see whether that broken clock can change. But that's about it. So it should be. I'm expecting a quiet week next week. But Mark and Eric will be here for you on Friday with another podcast because market's open. Let's see what happens. And Ryan and I will be both on vacation, so you will leave you guys in good hands. But I think that about wraps it up for this week.
Yes, thank you all our listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget our YouTube channel is youtube.com/DoubleLine Capital. We have a couple of good videos up. We have Bill Campbell was on Bloomberg TV, I think yesterday. He had a pretty good segment there talking about Treasuries, so that was a good one. And of course, Jeffrey Gunlock's webcast from Tuesday. The replay is up on that, and that was titled Surreal. And I guess given where we are today in markets and in the world, I think Surreal is a very apt title there. So I'd like to thank everyone for tuning in and hope everyone has a great Father's Day weekend.
Thanks, everyone. Take care. Have a great weekend as well.